Mr. Ruben, you can also so that we can see if you can share. All right. So
Okay,
welcome
Mr. James.
to our session today. Please ensure that your mics are muted during this question that you might have. Let's ensure that our mics are muted so that we won't be disturbing our lecturer today. But if you do have a question, you are free to send a chat message on the platform or unmute yourself and ask this question that you might have. So my name is James, and the name of your lecture today is Ruben. We are teaching you accounting for study students. Just the introduction to accounting part. That's what we are looking at. As I've highlighted in the lecture, today's lecture is going to be for free. It's just so that you can see our faces and know what we are all about in the section before you make the decision to join our usual classes. So we would like to have this class every Saturday. We can change the date if you prefer a different day, but we would prefer if we would have only Saturday like this every Saturday where we meet, we discuss you work, and we help you where we can. So in terms of the lectures that we do the lesson, the content of your study module. Then we also do assignments in terms of we teach you how to do assignments. We go through all the assignment questions that you've been provided by your lecturer within the class so that you can get 90% or 100% on your assignment. Then lastly, we will also do exam preparation with you, where we are going through past exam papers in preparation for exams. I know you guys are now doing venue-based exams, so you need to be prepared to confront the examination on the day that you're going to write. So we are also going to do that for you. Now, for those of you that might be asking, what is this going to cost you? So our cost usually, we say 250 Rand every month, or alternatively, you can just pay it all at once, 750. So it's 750 for the whole semester, or you pay 250 per month for the next 3 months. So we're going to be doing these lessons for the next For the next 3 months until we finish our study module. So we are hoping that we'll finish it early, but even if we don't finish it early, our promise is we're going to go through everything that you need to go through for you to prepare for your assignments and for your exams. Now, you are free during this lecture to ask as many questions as you want. Like I said, you can unmute yourself and ask the questions. Then after the lecture, I will send the recording of this video to the group so that all who want to revise, you can also revise. Mr. Ruben, I have the class.
Yes. Okay. Thank you very much, Mr. James. As said by Mr. James, my name is Ruben, and I'm going to be taking you for introduction to financial accounting, ACC 101. So, as Mr. James has iterated, this is a sample lecture. And of the topics that you are going to be doing in this semester, the first one is the accounting world. The second one is the conceptual framework. And the third one is the accounting equation, which is the one that I have chose to present to you guys for the purposes of today's lecture, mainly because the other two are theoretical. And for a first lecture, I thought it would be ideal to go with them something with a little bit of workings so that the lecture is not boring. So I'm going to be talking about the accounting equation, but before I talk about the accounting equation, I want to define to you what accounting is. So in this lecture, I'm going to define to you what the subject is. I'm going to talk about the accounting equation. I'm going to define the components of the accounting equation. I'm going to talk to you about the transaction. And then lastly, we are going to attempt question number 1 of your assignment. So we're just going to do a few transactions there so that you know we put the theory that I would be explaining to you into practice. So feel free to ask questions along the way, and feel free to take notes. I'm not going to be telling you take this down or take that down. You're going to take what you deem is important, and then we'll see the rest as we move on. So firstly, we cannot do an accounting equation before we clarify what accounting is. So the first thing to note is that accounting is the process of identifying, classifying, recording, and summarizing of business transactions in monetary terms. So you'll find that the definition might be a bit ambiguous, but you'll note that as we conduct the accounting process, the processes themselves are actually easier than the definition. So you see that to first identify a transaction, we will classify a transaction, we will record it and summarize it. Why are we recording it and summarizing it? For the purposes of interpreting and communicating the results to the interested parties. Remember, as we conduct business, there are people who are interested in our business. Either they want to invest in our business or they want to lend us cash. They need to know from our books of accounting if we are credit worthy. If they lend us cash, can we be able to pay them back? If they invest in our business, are they able to get a return out of that investment? So that is the main purpose of accounting. So by performing the accounting process, the aim is to come up with a true and fair view of the business. So what we want to achieve at the end of the day is a true and fair view of the business. And how do we achieve the true and fair view of the business? We make sure that we balance the accounting equation. So the accounting profession as a whole is based on the accounting equation. The hassles and tussles in the profession is so that this equation remains balanced. So the equation states that assets is equals to owner's equity plus liabilities. So as I said, I'm going to be explaining each and every item of this equation so that it makes sense when we actually do the calculations. So like any other equation, the accounting equation must balance. The left-hand side must be equal to the right-hand side. As long as we are able to balance the equation, then we know that our financial statements present a true and fair view of the business. So we want to define the components of the equation. I would like us to talk about assets. I have made an assumption that you guys, since this is an introduction to financial accounting, I made an assumption that probably you guys have not seen these terms before, or if you have, it would be for the best just to remind you what they mean. So every business has got assets, which is the component on the left-hand side of the what? Of the equation, assets. We are told that these assets should be equal to owner's equity and liabilities. But what are assets? Assets are just items that are owned by a business. So suppose you are running your business and you buy your motor vehicles. That motor vehicle is an asset. You are running a business, you need buildings to conduct your businesses in. And suppose you are not renting them, you bought your own buildings, those buildings becomes assets. Um, you are trading perhaps in a certain product, groceries, those groceries are assets. So assets are items that are owned by the business. Anything that belongs to the business is called an asset. And these assets can be categorized into two classes. The first class is the current assets, and the second class is the non-current assets. So with the current assets, these are the assets that we expect to use within a period of 1 year. So the currentness or the non-currentness of the assets is determined by the period to which we are going to use those assets for. If we are going to use an asset for a period of a year or less than a year, we call them current assets. But if we are going to use an asset for a period of more than a year, suppose we are going to use it for 5 years or 10 years or so on, then it becomes a non-current asset. So the difference between current assets and non-current assets lies in the period with which we expect to be using those assets for. So I just want to give you examples of current and non-current assets. On current assets, we've got inventories. Inventories are the stock that we trade in as the business. I have given an example of suppose we are trading in groceries. The groceries that we keep are inventories, and those inventories are current assets. And we also have debtors as current assets. Debtors are people who owes money to the business. Suppose we sell our goods on credit on the hope that our customers will pay on a later date. We create what we call debtors. Those debtors are current assets because that money belongs to the business, and it is only fair and true that we record it under the assets of the business, because one way or the other, the person that we have sold the goods to is bound to pay. And then another example of a current asset is the cash of the business. So as we conduct our business day-to-day runnings, we receive cash. That cash, we record it under current assets, sorry. And as well, the bank account of the business is a current asset. And on the non-current asset, I have said, we put items that we expect to be holding for a period of more than 1 year. And these items includes the land and the buildings that we would be using. It includes also the vehicles, suppose the company bought vehicles, and also equipment if we make use of any necessary equipment. So that's the demarcation between the current and the non-current assets of the company. Would like to move on to another term on our accounting equation, which is the liabilities. So liabilities are amounts that are owed by the business to other businesses. So if we can sell goods on credit to other customers, it means we can also buy goods on credit from our suppliers. When that happens, we create what we call liabilities. Not only in that scenario do we find the creation of liabilities, but also suppose we get a loan from the bank and we are bound to pay that loan back to the bank, it becomes a liability. So a liability is simply an amount that we must pay to another part that is not within the business. If we owe someone, if we buy goods on credit from a supplier worth 500 Rand, it means we've got liabilities of 500 Rand. If we are given a loan by the bank of 10,000 Rand, it means we've got liabilities of 10,000 Rand. So liabilities, like assets, also have got two classes, which is the current liabilities and the non-current liabilities. And these classes are also determined by the period to which the liability should be settled. So suppose we buy goods on credit. Surely we're expected to settle that credit within a period of less than a year, depending on the nature of the transaction, or within a period of some we've got 30 days, 60 days, or 90 days. So those that we are required to settle within a period of 12 months or less are called current liabilities. And those that we are required to settle after a period of a year are called non-current liabilities. Suppose we take out a loan from the bank, and obviously if we borrow, suppose 20,000 Rand, or rather 500,000 Rand, there's no way we are expected to pay it back in the current financial year. We only borrow to pay back in the preceding periods. So that becomes a non-current liability. So if you are expecting to pay within the next 12 months, it's a current. If you are expecting to pay after 12 months, it's a non-current liability. And also, these are the examples of current and non-current liabilities. For current liabilities, we have got creditors. Creditors occurs when we buy goods on credit. Suppose we go to a supplier and we say we are facing cash flow problems. We don't have enough cash at the moment, but would like to borrow some goods so that we can maintain our operations. They give us those goods and we create what we call creditors. Creditors are people whom we owe money because they have given to us goods for operations. So that's one example of a current liability. Another example is a bank overdraft. A bank overdraft occurs when the bank allows us to use more money than that which we have in the bank account. So suppose we've got 20,000 in the bank account and we want to make a transaction of 25,000 rands. The bank allows us to do that. This facility is usually offered to businesses. So the bank allows us to pay for 25,000 rands when we only have 20,000, with the anticipation that we are going to pay back the extra 5,000 within a certain specified period, be it a month, be it 2 months. It cannot be more than 6 months or quite a number of months, but a reasonable period of time, so that the bank can also finance its activities. So that's how a bank overdraft come to arise. And when we have a bank overdraft, we have a current liability, because a business cannot sit with a bank overdraft for a long period of time. Remember, what we want in our bank is a favorable balance, or a positive balance. So we ought to pay this bank overdraft within the fastest period that we can. And then there are certain types of loans that are required to be paid within the period of 12 months. Suppose we just borrow 5,000 rand and we know that we can pay that back within a period of 12 months. That would fall under current liability. And then non-current liabilities, we will find long-term loans. Those loans that which are required to settle within a period of more than a year. They become long-term liabilities, and they are non-current liabilities. So long-term loans are non-current liabilities. We also look at mortgages. Mortgages comes to rise when we go to the bank and we say, we have got title deeds of these buildings. So we are going to give you these title deeds. In exchange, you give us cash to finance our operations or to do so this and that. At the end of the mortgage, or when we finally pay you back, you are going to give us our title deeds. But if we fail to pay you back, you are going to take those title deeds together with our buildings, and those buildings would belong to you. So a mortgage is a non-current liability. Okay, so to move on to the other aspect, which is the final aspect of the accounting equation. If you took it down, it says asset is equals to owner's equity plus liabilities. So now we want to look at the owner's equity. And owner's equity is simply what the business owes to the owner of the business. Remember, when you are running a business, you do so with the motive of making a profit. And that profit which you would have made, or the money that you would have invested in that business, belongs to you as an owner. So that portion which belongs to the owner of the business is what we refer to as the owner's equity. The owner's equity is composed of four things. The first thing is the capital. The capital is the money that the owner invests in the business. So you want to start a business, you put your money in the business. That is what we refer to as capital in accounting. Then we've got the income, or sometimes they would write the revenue, sometimes they would write the sales. That is the money that you receive from conducting your operations. Suppose you are in the selling of groceries, you sell your 10 kgs of rice, you receive an amount of money that is income, or that is revenue. That belongs to the owner, but the owner cannot take it now. He can only take it at the end of the financial period. So of course the business owes this amount to the owner, but the owner can only take this amount at the specified period of time. And then under owner's equity also we've got expenses, or the costs. So you'd understand that for a business to run, for us to effectively run a business, we should incur certain expenditure. We should spend money on certain things. Suppose continuing with our groceries business, we would need perhaps the buildings to conduct business on, and we decide that we cannot afford to buy a building. Instead, let us rent one. When we pay for those rentals, those are expenses. And if we want people to know of our product, we are going to pay for an advertising expense. That is an expense. If we want to insure our business against theft or any other risk, when we pay that insurance premium, it's called an expenses. It's called an expense, sorry. And when we pay for salaries or wages to our employees, those are called expenses. So any amount that we spend for the smooth operation of business is called an expense, and it falls under owner's equity. We also have drawings under owner's equity. Drawings is the opposite of capital. Capital, I have said that it is the money that the owner invests in the business. Drawings occurs when the owner takes out money from the business before the period that I said he should take is arrived. So suppose he's supposed to take money out at the end of the year, at the 31st of December, and the owner decides that no, I need money now, and today is the 12th of February, and he goes on to take a certain amount. That amount is what we refer to as drawings. So when an owner takes money from the business to use for his personal use, we refer to that as drawings. So that's it in as far as the owner's equity is concerned. We will see more when we try to tackle an example. So those are the three components of the accounting equation, which states that assets is equals to owner's equity plus liabilities. So now we want to define what we call a financial transaction. So in the accounting world, things happens through transaction. When you sell your goods to a customer, we call that a transaction. So you find that the bookkeeper records transactions of the business from day to day. And as accountants, when you take those transactions, you are able to what? To analyze them or to record them so that you can prepare your financial statements. So a financial transaction is simply an accounting event that is of monetary value. Also remember, if something is not of monetary value, then we as accountants, we cannot deal with it. We only deal with things that has got a monetary value. So a transaction is an accounting event that is of monetary value. There are certain things that we should know about each and every transaction. Each and every transaction, there are certain things that we should know. Perhaps if you would want to take this down, because it forms what we call the double entry bookkeeping system, which is of vital importance when we try to balance our accounting equation. It is the reason why our accounting equation remains in balance actually. So number one, each transaction has got two accounts. So we go to a transaction, we must find there that there would be two accounts. No matter how small the statement is, there must be two accounts. Then number two, one account of those two is debited, and then the other is credited. Of those two accounts, one is debited, the other one is credited. And then whom do we credit? We credit the giver and debit the receiver. This is the golden rule of accounting. We credit the giver and debit the receiver. And then we always view transactions from a business perspective. Because remember, as an accountant, you are employed by the business, and all your loyalty lies with the business. And therefore, you have to view each and every transaction from the business perspective. Okay, that's it about a transaction. Then how do you approach a transaction? There are basically three steps of approaching a transaction. Number one, you first identify the two accounts involved. That is important. You first identify the two accounts involved. How do you identify those two accounts? You trace where the money is going or where the goods are going. So in accounting, it's either we are dealing with money or we are dealing with goods. So for you to identify the two accounts, you trace where the money is coming from or where the goods are coming from. That's one account. And then you trace where the money is going or where the goods are going. That would form another account. So that is of importance. And then number two, of those two accounts, you identify which account is giving and which account is receiving. So one account is bound to be giving and the other account is bound to be receiving, giving either cash or goods and receiving exactly the same. After identifying that, you proceed to credit the giver and then you debit the receiver. You proceed to credit the giver and then you debit the receiver. So this is an example of a transaction. This is an example of a transaction. So we want to apply the above mentioned steps in dealing with this transaction. Number one, we said identify the two accounts. So we first read the transaction and it reads, the company bought stationery worth 100 Rand in cash. Stationery are those things that we use for office use, printing paper, ink cartridges, and so forth, writing pens, pencils, etc. Those are stationery. So we are being told that the company bought stationery worth 100 Rand in cash. So what is the first thing that we do? We identify the two accounts involved. How do we identify? We trace the movement of cash or the movement of goods. What is the business doing? The business is buying stationery using cash. So the money is coming from where? From the cash account of the business. Obviously, if we are going to buy as a business, we are taking it from the cash account or the bank account of the business. But in this particular instance, we have been told that we utilized cash. So one account that there is to this transaction is the cash account, because we know that money is coming from where? From the cash account. And where is it going? It's going to buy stationery. The money is going to buy stationery. So stationery becomes another account. So we have completed step number one. We identify the two accounts. We have got the cash account and the stationery account. We now want to move on to step number two, which says that of those two accounts, identify which account is giving and which account is receiving. So what is happening here? The cash account is parting ways with 100 Rand and the stationery is receiving what? 100 Rand. If we are looking at this transaction from the business perspective. So the cash account is giving and the stationery account is receiving. So just for illustration purposes, I'm going to write here, this one is giving, the cash account, and then the stationery account is receiving. So we've got two accounts. We have identified which one is giving. We have identified which one is receiving. What then is our next step? We proceed to credit the giver and debit the receiver. We proceed to credit the giver who is giving the cash account. It means we are going to credit the cash account with what? With 100 Rand. And we are going to debit the stationery account with what? With 100 Rand. So because we have debited and credited, we have debited one account and credited another account, our accounting equation is bound to stay in balance. We will see from the illustration of your class assignment in the following slides. So that is how you approach a transaction. That is it pertaining the accounting equation, and it is of paramount importance to know the accounting equation from the back of your heads, because it is the backbone of the accounting profession. As we do what we do, the motive is to make this equation remain in balance. If it is in balance, then we know that the business is showing the true and fair view of the company. So would like to proceed to your class assignment. We will perhaps attempt a few transactions, and then I would like someone from the crowd to get one as I tackle 3 or 4. I'd like one to take us through the process. Then I know I'm talking to people. Okay, so we want to move on to your class example. That is if no one has got a question at this point. Do we have any questions at this point before I proceed? We don't have questions. We don't have questions. That's good. Okay, so question number 1 from your assignments reads, Patek Platinum trades in office furniture. The following transactions took place during August 2021 for Patek Platinum. So we only read the first part and we don't read the transactions. We quickly go to the requirement. What are we required to do? So when you are faced with any question of this nature, you only read the first part and the requirement. Then you, after that, you go to the transactions. What are we required to do? We are required to enter the transactions above in the accounting equation below, applying the duality concept, ignore VAT. So the duality concept is the double entry concept that I said. It says that you debit the giver, you debit the receiver and credit the giver. And also, you might find that the double entry or the duality concept states that for every debit entry, there is an equal and corresponding credit entry. You might want to put this down. For every debit entry, there is an equal and corresponding credit entry. That is how our equation comes to balance. So I'm just going to copy this one and put it in Excel. We are going to utilize Excel for this question. So we are required to use this format. If the question requires us to use a format, we use that specific format. So I took it upon myself to put the format here. And then I want to paste the questions somewhere where we can see them. Okay, there we go. And then on this pane here, we see that we've got a summary of the accounting equation. We've got a summary of the accounting equation. I made an assumption that you guys have never seen this before, and therefore I'm trying to explain everything in detail. So this is our accounting equation with assets here, both non-current and current assets, owner's equity and the components of owner's equity, as well as liabilities and the components of what? Of liabilities. So we are going to approach each transaction and determine its effect on the what? Assets or equity or the liabilities, which is the accounting equation of the company. So I'm going to read transaction number 1. Transaction number 1, it's just that the owner, Mr. Pete Patek, made a capital contribution to increase his capital from 175,000 Rand to 250,000 Rand. This was done by means of an electronic transfer from our account to the business's bank account. So we are told that the owner increased his capital. The owner increased his capital. So the first thing that we do is to identify the two accounts that are involved. is to identify the two accounts that are involved. I have said before when I was talking about the owner's equity that when an owner introduces money in the business, it's called capital. And therefore, we already know that we have got a what? A capital account, but we want to identify where the money is coming from and where the money is going. The money is coming. So the first account that we have, not that this is just a working sheet. Confirm if you guys can hear me. I'm having internet problems, I think. Can one person just confirm if you can hear me?
Yes, we can hear you.
Okay, thank you. So the first account that we have is the capital account. Where is the money going? Was done by means of an electronic transfer from his personal account to the business's bank account. So this was done by means of electronic transfer from his personal account to where? To the business's bank account, which means if you are going to look for the money right now, it is sitting in the business's bank account. So the other account automatically becomes the bank account. The other account automatically becomes the bank account. That's the first step of identifying the two accounts. Now, we want to identify who is giving and who is receiving. So the owner is receiving that capital. So capital is giving and the bank is what? Is receiving. And we've said that we create the giver and debit, there is capital, and then we are going to debit, and bank is receiving, we debit it, okay? Once we identify that, we want to know the amount that we are going to debit and the amount that we are going to credit. So we have 75,000. So if we are it means the 170,000, 175,000 has already been recorded. It's only
Hello? Hi, Ruben.
the difference between 175,000 recorded in our books. And therefore, yes, Mr. Can you hear me, Mr. James?
Yeah, I think you're breaking up a little bit.
Okay. I'm sorry about that. I think I'm having internet problems. But can you hear me clearly now?
No, we definitely can hear you. It's just that here and there, something that happens, but we can hear you.
So what we are worried about is in the capital invested. The 175,000 has already been dealt with when he introduced it. Now we want to deal with the remaining part that he said to have increased. How much is the increase? We just find the difference between the 250,000 and the what? 175,000. And which means that he what? And those are that is the amount, okay? So once we identify this, we go to present our answer. This is transaction number one. We write transaction number one here. I like it on the left side of the cell. Okay, so what do we have? Which accounts do we have? Remember, we've got three classes on the accounting equation. We've got the asset, assets, we've got the equity. We have is the capital and the bank account. So does it go under assets? Does it go under owner's equity, or does it go under liabilities? And I took it upon myself to provide you with this summary, which states where what goes. So for capital, we will find it under owner's equity. We will find capital under owner's equity, and it has got an impact of increasing owner's. Can you hear me, guys? Can anyone hear me? Can anyone respond?
Hello?
Yeah, we can hear you.
Okay, thanks. Okay, so we want to, capital has got an impact of being increasing the what? The owner's equity. It has got an impact of increasing the owner's equity. And then from the, let me just cross. Okay, thank you. Owner's equity must have a credit balance. And okay, let's just put the credit balance here. Yeah, anything that increases owner's, anything that decreases the owner's. So you should take note of these debit plans and credit plans. Everything that increases that account goes to the debit, and everything that decreases that account goes to the credit. If an account has got a credit balance, you will see the plus sign on the credit, and therefore everything that increases that account goes to the credit, and everything that decreases that account goes to the debit. And we were told by this transaction that we increased our capital by 75,000 rand. And if we increase, it means that it goes to where the positive sign is. The positive sign is on the credit, and under what? Under equity. Under equity. So we are going to increase our equity by 75,000 rand. And then we go to the bank account. So we have recorded the capital account. We go to the bank account. The bank account, we are told that we are supposed to debit it with 75,000 rand. So the next problem that should come to our mind is to think that what class does the bank account falls under? Is it an asset? Is it an equity? Is it a liability? So with time, you see that you come to know by head what it is. If you don't already know, it's just an assumption that I made. So the bank account of 75,000, we are supposed to debit. So we come here, we try to navigate to see the bank account, and we see that we find it under current assets because the bank is a current asset to the business. So we are supposed to do what to the bank account? We are supposed to debit it with 75,000 rand. So we go to the debit side of the assets and add our what? 75,000 rand. So maybe just to illustrate, to reinforce what I've been saying, that the equation should balance. Asset should be equal to equity plus liabilities. Let's put a summation here. Just want to sum this one. Then we want to sum this one. Okay, let's sum this one first. Our equation should stay in balance. Our equation should stay in balance. As long as it is in balance, then we know we are doing just by the accounting profession. So we have said assets is equals to equity plus liabilities. So we want to look at the second transaction here. This one we have done, so we might as well delete it. What does the second transaction say? It says, okay, let me highlight it so that we know where we are. We purchased the trading inventory from Rollo Traders on credit worth 34,658 Rand. So I have said before that the first step is to identify the two accounts. The first step is to identify the two accounts. And how do we identify the two accounts? We trace the movement of cash or the movement of goods. Where the cash or the goods are coming from, that's one account. And where the cash or the goods are going to is the other account. So we want to first trace where it is coming from. Then we will know where it is going and what it is that we are tracing. We have purchased trading inventory from Roller Traders on credit. So we purchased something on credit. Trading inventory are the goods. So we are tracing goods. Where are the goods coming from? The goods are coming from Roller Traders. So Roller Traders becomes what? One account. Roller Traders becomes one account. And then where are the goods going? Where are the goods going? The goods are going to the inventory account. But when we purchase inventory, when we buy goods for the purposes of reselling them, we call them purchases. So whenever you see a return purchased something, it means we've got a purchases account. Of course, we've purchased inventory, but we term them what? Purchases. We term them purchases. So we've got purchases and Rollo Traders as our two accounts. We want to identify who is giving and who is receiving. Rollo Traders is obviously giving us goods. So we proceed to credit the giver and debit the receiver. So we credit Rollo Traders and then we debit the what? The purchases account. With what amount? We credit with the amount of 34,658. 34,658. So the amount that we credit is the very same amount that we debit, as the double entry concept states. For every debit entry, there is an equal and corresponding credit entry. So we want to credit Rollo Traders with 34,658, and we want to debit purchases with 34,658. But before we do that, when we buy goods on credit, we create what we call trade payables. So instead of writing Rollo Traders, you can opt to write trade payables, or using the examples that I gave you, we create what we call creditors. And I said, if you were listening attentively, that creditors are what? Are current liabilities. Creditors are current liabilities, and they occur when we what? When we buy goods on credit. So we have created creditors. Okay, so the first account is Rollo Traders, and we've created what we call creditors. We are going to credit them. So you might as well go and write number 2. We might as well go and write number 2. Okay, how much? Okay, first, whom are we crediting? Rollo Traders, which we said is a creditor. And creditors, if you want to know what creditors are, we just come here and we navigate creditors. Creditors, we find them under current liabilities. We find them under current liabilities. So creditors, we find them under current liabilities. So we are going to credit current liabilities with an amount of 34,658, with an amount of 34,658. Sorry, we must put it at the bottom here. Okay. And then when we do that, we want to debit the purchases account. We want to debit the purchases account. The purchases account has got the same effect as the assets of the business. As I said, what are we purchasing? We are purchasing inventory, and inventory is an asset which we find under non-current assets. So the same way we deal with inventories is the very same way we deal with purchases. So we come to debit the assets because we find inventories under what? Under assets with the amount of what? 34,658. 34,658. And our equation is bound to stay balanced. In this particular, I said assets is equals to equity. This is equity plus what? Plus liabilities, which is 109,658. And then we have got 109,658 on the asset side. So as long as our equation is in balance, the left-hand side is equal to the right-hand side, then we know that we are doing justice to the accounting equation. So let's look at the third transaction. This one we have done, so we might as well do away with. We now want to look at the third transaction. We are told that we sold merchandise on credit to diamond dealers, 9,000. Inventory is marked up at 60% on cost. Inventory is marked up at 60% on cost. So in accounting, they don't give you information for interest's sake. They give you information so that you use it. Whenever you see anything written, when you are attempting an accounting question, know that you must use that certain piece of information to your benefit. If possible, you must make necessary assumptions so that you what? You use that piece of information, but every assumption that you make must be disclosed. You learn this as we go on. So we are told that we sold merchandise on credit to diamond dealers of 9,000 rand. And then we are told that inventory is marked up at 60% on cost. Why are we told this second part? We will deal with it later. Firstly, let us identify the two accounts involved, which is our first step to identify the two accounts involved. Okay, so I'm going to ask one person to do the following transaction. Any willing volunteer? The one that says paid casual wages for petty cash of 1.2. Any willing volunteer? So start prepping for that particular transaction. So we are told that we sold merchandise on credit to diamond dealers. We want to find the two accounts involved. Only if we are told that it was on credit, it means there was no movement of cash. There was no movement of cash, which means the only movement that we can trace is that of goods. Who is receiving the goods? We sold to diamond dealers. So diamond dealers is receiving the goods. Diamond dealers becomes one account. And then who is giving the goods? Whenever we are told that we sold, it means we have created what we call a sales account. The business is giving away the goods, but making use of the sales account. So the other account becomes the what? The sales account. Once we have established that, we want to see now whom are we going to credit and whom are we going to debit. And we have talked of the golden rule. We credit the giver and debit the receiver. What is diamond dealers doing? Diamond dealers is receiving goods. So if he's receiving, we are bound to debit him. He is the receiver. That makes the sales account a credit entry because it's what? It's giving. Now, how much are we debiting and how much are we crediting? We want to look at the second part of the transaction now. We want to look at the second part of transaction. Inventory is marked up at 60% on cost. So we make a necessary assumption that this 9,000 Rand we were given is the cost price of the what? Of the goods. We make a necessary assumption that the 9,000 that we have been given is the cost price of the goods. If we acquire our goods at 9,000 from our suppliers, we bought these goods at 9,000. We cannot sell them at 9,000 because that way we are not going to make any profit. We must put a certain percentage of profit so that we arrive at the selling price and the business is able to make what? To make profits. So from cost, a business adds a markup percentage to arrive at the selling price and therefore make a profit from the what? From the transaction. So the cost, we have ascertained that it's 9,000. We were given this. And then the markup, we were told that it's 60%. So what is markup? Markup is the percentage cost, is the percentage rate that we apply to the cost so that we arrive at the selling price. Is the percentage rate that we apply to the cost so that we arrive at the selling price. So for every product that we sell, we must add a markup to arrive at its selling price. Suppose you're buying a product for 10 Rand and your markup is 10%, which is 1 Rand. You are going to sell them for 11 Rand and make a profit for what? For 1 Rand. That is simply what markup is trying to achieve. So we want to calculate 60% of what? Of 9,000. We want to calculate 60% of 9,000. We find that 60% of 9,000 is 5,400. So that is this is the profit that we are subject to make from the transaction. So for us to make this profit, how much should we charge the customer? We should charge him the cost plus the profit that we are supposed to make. And then it comes to 14,400. So we are going to debit how much? 14,400 and credit how much? 14,400 for us to be able to make a profit out of that transaction. Now, the next headache that we have is to know which account are we going to debit, which class are we going to debit, which class are we going to credit. So we might write our transaction number so long, which is number 3. And we want to come to Diamond Dealers, which is our first account here. Or okay, Diamond Dealers, which is our first account. It happens to have a debit balance, but it is wise to always start with the account that has got a debit balance and then move on to the account that has got a credit balance. So Diamond Dealers, we have sold goods on credit. And I explained earlier when I was talking about current about the fact that when we conduct business, sometimes we sell goods on credit, and those people that owes us the money that would have sold are called debtors. So Diamond Dealer, in other words, can be called a debtor, but the accounting profession is moving forward to removing the word debtor to trade receivables, to trade receivables. So you may just note that down if you want, but debtors are trade receivables, which are people to whom we sell goods on credit to. I have said what are debtors. Debtors falls under assets and current assets to be specific, because these people are bound to pay us legally. They are bound to pay us, they have to pay us. So we might as well consider that amount, that money to be our money, because at the end of it, they are going to pay. So by that hand, it becomes a current asset. So we are going to debit the assets with an amount of what? 100 or 14,400 14,400. So we are going to debit the assets with an amount of what? 14,400. Then we move on to the next account, which is the sales account. We want to know which class does the sales account falls under. Is it an asset? Is it an owner's equity? Or is it a liability? We just navigate through to find the sales account. But under an exam situation, you won't have this table here. So it is of importance that you know which type falls under what class. Sales, we find them under the owner's equity. Remember, we talked about income that time. So it's part of income. And what do sales do? They increase the owner's equity. So we go to the owner's equity, we find where the positive sign is, it's on the credit side. And then we put that what? The amount that we are going to increase it by, which is 14,400 Rand. So at the end of it all, if we sum up the liabilities and the assets, the amount should be equal. If we sum up the liabilities and the equity, the amount should be equal to the total assets. Then we know that our equation is in balance. Okay, that's it about this transaction. Do we have any volunteers for the following transaction, or should we call it a day? Any volunteers? Anyone to do for us the next transaction? Going for 3 seconds. 2, 1, no one. No one to do for us, that's fine. We would have to end there for today since the hour is gone by. So that's it about the accounting equation. You just have to continue with the process of how you deal with the accounting equation, how you deal with the transaction, and balance your accounting equation. The most important topic in accounting. Okay, I think that's it from me, Mr. James. Or if any of the audience has got questions, Mr. James will hand over the platform. Mr. James, over to you, sir. Mr. James. Okay, let's just wait as I try to contact Mr. James. He should have something to say at the end of this lecture. He should have something to say. But from me, thank you guys for attending the lecture, and I hope that you have understood. Mr. James? Hello? Oh, we had completed where we wanted to, what we wanted to do today.
Wonderful. Okay. Thank you guys for coming in. I hope you had a pleasant lecture, and I hope you all join through for next week. As I highlighted at the beginning, the cost is 750 Rand for the semester, or you pay 250 per month for the next 3 months to join through the classes. So I hope you all are going to join through. I'm going to post a video in the group, and I'm also going to post the banking details and etc. for those of you that want to join. I hope you all have a pleasant evening. Good night.